Hello, everyone. It's Professor Reiko here again, continuing on with our investment chapter. This is our seventh lesson that we've done together, and today we're going to focus on the equity method. All right. So remember, when we're talking about investing in equity securities, there's the fair value method. That's when we have a passive interest less than 20%, and then we had this when we own between 20 and 50%. We call it the equity method. All right. And this suggests that we have significant influence. So you have to have significant influence in order to use the equity method. I mean, technically, if you own 20% of the stock, you're probably one of the larger shareholders. However, there could be examples where you have 30% of the stock and somebody else owns 70. And if so, then your influence really doesn't matter. All right. So typically, though, most textbooks will add a sentence into all the problems, and even on your test where it says this ownership level or something like that gives them significant influence over the investee. Okay, and that's kind of your cue that you're using the equity method. So what does significant influence mean? It just means because you have so much shares of stock, that means you get to vote those shares, assuming they're common stock. And that gives you a lot of power. So you might be able to get people on the board of directors that you want, which will allow you to have some participation in policy-making processes. Material intercompany transactions, that means, remember, we're a company buying a lot of stock of another company. That means we can do a lot of things back and forth. Think like Pepsi and Pepsi Bottling are two companies. Interchange of managerial personnel. If we're doing a lot of business back and forth, it makes sense that people could move from one company to the other fairly easily if we needed that. Or if they wanted just to make a career move, it might be a good move for them. So what is this equity method? How do we account for it? So this is just a brief overview. And then what we're going to do on the next video together is we're going to walk through a comparison of the equity method and the fair value method, do them both side by side so you can see how to account for it. Most textbooks will give you a good side-by-side example as well. I know both the Spice and Kiso book do. So use those examples as well. The more examples you can look at, the better off you are going to be. All right, so we are going to record the purchase at cost, which means the journal entry will look exactly the same as the fair value method. We're just buying the asset and putting it on the books. All right. The big difference is instead of adjusting to fair value at the balance sheet date, we now are going to adjust based on the changes in the investee's net assets. So if you think about net assets as assets equal liability, if you think about the accounting equation that you learned probably the first day of accounting, if you just rearrange some stuff, net assets, meaning the assets minus liabilities, is the same thing as equity. So what we're kind of focusing on are changes in equity. And the main change that we're going to look at is retained earnings. Remember, retained earnings is a portion of that. So if we kind of skip down here, this formula is used a lot. The ending retained earnings is just what we start the year with, the beginning retained earnings, plus net income minus dividends. So net income increases retained earnings. I mean, if you think about income and earnings are the same thing. Those words are used interchangeably. So retained earnings are the earnings, net income, that are retained in the company. The earnings that are not retained are dividends that are paid out to our shareholders. So if you look back up here, we're going to recognize our proportionate share of earnings or losses if they have it. And that's going to, so assuming it's income, it will increase our investment. And losses will decrease our investment. And then dividends decrease our investment because down here, they decrease retained earnings. So you can see we're not, what we're doing is we're recognizing that we have this economic relationship between the two. And so we're going to, as the company we're investing in prospers, we are going to increase our investment. If they are doing things that lower their retained earnings, then we're going to decrease our investment accordingly. So that's just how we account for things under the equity method. So all the wording here, we don't have any numbers yet that we're going to do on the next lesson. So it may seem a little confusing at first, but what you'll find, I think anyway, is that the equity method is the easiest one to account for because every journal entry is either increasing or decreasing the investment. So that's it. If we start from that point, I can always think, all right, am I going to debit or credit the investment? What's going on? Am I increase? Is their retained earnings going up? If so, I'm going to increase my investment. Is their retained earnings going down? If so, I'm going to decrease the investment. Okay. So this is just a brief overview to the equity method. We'll switch gears in the next video and put an example on where we compare the fair value method to the equity method. So I think that will, I would watch that one right after you watch this one, and it should kind of make sense what we're doing there. So hope you're enjoying this little overview. The next one will be a full-on example of the two methods, so just be sure to tune into that. Thanks.